Management buyout, IPO, trade sale, private equity secondary. These are all terms you've probably heard of but never really understood what exactly they mean. These are all common private equity exit strategies, and I'm going to go into a bit more detail into how private equity firms actually exit from their investment. But first, I think it's important to get a basic understanding of why private equity companies need an exit strategy for these portfolio companies. Now, a private equity company is designed to take investors' money, limited partners, into a fund, and the general partners, the GPs, invest this money into private companies. When this money is invested into private companies, they try and improve them so that they make more money, they have organic growth, inorganic growth, and really grow. Eventually, after between 3 and 4 years, certainly in mid-market, the general partner needs to sell the portfolio company to return money to the investors, who are expecting around a 3 to 4% money multiple. So they need to think of an exit strategy. They need to sell this to some sort of buyer. And the most common exit strategy for a portfolio company is to sell it to trade. Now, what this means is this portfolio company, let's say it's a technology company, is sold to one of its competitors, but typically these competitors are much larger players in the market. Now, if I was to use an example, let's say this technology company is playing in the same market as Microsoft, but Microsoft is a much larger corporation than this technology company. Now, it's quite common for Microsoft to acquire the portfolio company of the private equity company, and this is one of the most common exit strategies in private equity. The only issue with doing this is Microsoft, the big corporation, will see a lot of cost synergies in acquiring this technology company from their private equity firm, and consequently they'll do a lot of layoffs from this firm, and this is why this isn't the most favorable exit strategy in private equity, but it allows the investors, the limited partners, to get their 3 to 4% money multiple. And consequently, one of the second most popular exit strategies in private equity is what you call a private equity secondary. Now, private equity secondary may sound a bit confusing, but it's extremely simple. It means the private equity company, which is currently holding the portfolio company, is sold to another private equity firm. This could be a private equity firm which is much larger, or it could be a private equity firm which is around the same size but thinks it can grow the firm a bit more. And that's the reasoning and thinking behind it. The private equity company that owns this portfolio company has hit the 3 to 4 year holding period, and they need to return this money to the limited partners, its investors. So they need to move this company on. Trade sale isn't really an option because potentially this portfolio company is the best in its market, and there is still a bit of inorganic growth or organic growth that it needs. So it can be sold to a mid-market private equity firm, or even a bulge bracket private equity firm, because the growth prospects are so much that it could potentially be IPO'd. Now, the third most common one is a management buyout, an MBO, which you probably haven't heard of before as it's quite an obscure one in the private equity space. This is when the initial private equity company comes in and they buy out the entire management team. So they buy 100% of the company. So they bought out management. This company is held for, once again, 3 to 4 years, and there's not really many exit opportunities or exit strategies for this firm. You can't really go to trade because it's the best one in the market. You can't really go to another private equity company and have it as a secondary because they're not really interested in it. But management are still interested in growing the company, and they want to share in the company as well so that they can benefit even more personally. So what they can do is they can use some of the money which was used to buy them out in the first place to rebuy their share and to buy out the private equity company. As a result, the private equity company will have the money which they can return back to their investors, and the new management team can continue to grow the company and mature it and continue growing, as they don't feel like they need the private equity company to help them with their growth prospects anymore. And finally, you've probably heard this quite a lot, and it's an IPO, an initial public offering. These are not as common in the private equity space, especially in mid-market from my experience, but this is very common in the bulge brackets or even venture capital firms. This is when the private equity company has bought a private company, fairly large, and decides as an exit strategy to sell the shares to the public. And this can be to investors like you and I. It could be to even a trade like Microsoft. The investors can be anyone. It's just sold to the public. And a brilliant example of this is Airbnb. In 2020, Airbnb was owned by a private equity company and was floated on the stock market. This is when the private equity company sold its shares to the public, and the valuation for the company was around 47 billion. So a lot of money would have been made from Airbnb. And as I said, this isn't the most common exit strategy, but it's certainly an exit strategy which could be used if worse comes to worse, especially in mid-market. And that is all of the different exit strategy used in private equity. Now, I hope you enjoyed this video, and please watch my other private equity videos, as I've made a whole series on explaining and going deep diving into private equity. Also, have a look at the books that I have linked in my description, which I've used to learn about private equity along with my experiences. Please like and subscribe, and thanks for watching.